We're here for a special edition of TabbFORUM. We are sitting in the NASDAQ OMX studio. I'm here with Eric Noll, Head of Transaction Services for NASDAQ OMX. And the topic of discussion today is really going to be about market structure. We've had the flash crash, we've had some other challenges with market structure. So the first thing I want to really talk about, when we look at an exchange, which of course NASDAQ OMX is one of the largest in the world, a lot of the things you focus really around is market quality. And to a certain extent, there have been issues within the market that people have been talking about. That is the quality of the markets good? Has high frequency trading impacted that? Has dark pool trading impacted market quality? So let's take a step back and I assume that you guys look at market quality a lot. When you look at market quality, what do we mean by market quality? And how does an exchange look at market quality, and how do you manage that?
Well, there's a couple ways we look at market quality. So, one of which is clearly, we have a large set of listed securities, and we have a large set of securities that we trade that may not be listed here. And so we want to look at not only the individual trading and market quality, but we want to look at the totality of trading and market quality. So not only the top trading names, but all of the trading names. So that's important to us to get the spectrum.
So you're not looking just at averages, you're looking really at large, mid, small, different types of liquidity patterns, because to a certain extent, if you look at average, it blends all together.
Right, and it can obviously be predominated by a large trading name that trades a lot, but for the individual investor, they care as much about their order in a very small cap stock that has very little volume as they do with a large cap stock that has a lot of volume in it. So it's important for us to sort of look at that in a holistic, across the spectrum way. So that's one area that we spend some time on and we want to concentrate on. The other areas that we want to look at and that we spend a lot of time on is how do we find liquidity? How do we make the markets so that there is liquidity, again, across the spectrum, not just in the large cap names, but across the spectrum, and how do we get quote stability? In other words, how do we maintain and put a quote out there that firms and investors can look at and say, there's a quote I can trade with, it's stable, it's there, it's
a quote they can trust.
A quote they can trust, exactly.
Now, when you look at things like that, how do you incent people to come in? How do you incent people to provide quotes? So, over the last 5 or 7 years, we've had a lot more electronic trading. Tick sizes or spreads have compressed. Trade sizes have gone down. There are some people who say, that when I try to come in for size, people aren't there. But on the other hand, the markets are faster. They seem to be more fluid. How do you bring people in and do that?
So we've done it a couple of different ways. So one way is what we call it our ISP pricing, or investor support program pricing. So what we've done with that, and this is about quote stability now, what we've done with that is we pay our highest liquidity provision rebates to firms that have a slow quote. And we define that slow quote in a way of having a trade to order ratio of 10 or less. So in order to earn our highest rebate tier, what you have to do is you have to have a relatively slow quoting process. In other words, your quotes have to be maintained and have to result in trades more often than not. And what we've seen with that is we've seen a better sense of our quote stability, not just in the top names, but across the board.
So to get the highest or the best pricing, 1 out of 10 trades 1 out of 10 quotes need to trade, basically.
Correct. That's absolutely correct.
So that's interesting.
So that we've implemented that. That seems to be working very well for us.
Are the market makers happy with that? Are the liquidity providers happy with that?
One of the things we've seen obviously is a shift in who our liquidity providers are, and so we've seen a shift towards more large bank order flow providers, away from more proprietary firms.
Oh, so like a shift back from traditional dealers
to more into a traditional dealer model, and that was by design on our part. Not so much that we wanted to benefit large dealers and against proprietary firms. Is what we were trying to do, though, is create an incentive scheme that provided for a more stable quote in the marketplace.
Interesting. Now, one of the other things that people are talking about in terms of quote stability especially in the small and medium enterprise side, is widening the tick, because part of the Jobs Act was supposed to be a study to say, what if we took the small cap stocks, that don't trade very often, and widen the tick and make it, quote unquote, a little bit more stable. Now, some people look at that and say, great, wider quote, more liquidity aggregating at the bid or the offer. Other people say, well, the HFTs are just going to dominate the bid and offer, and it's just going to be a larger incentive, for those guys to, they're just going to wind up trading more and kind of box out, traditional investors. How do you look at that?
Well, so we've generally been in favor of a pilot to look at varying tick sizes. And I think a pilot's a good idea here. And clearly the SEC is coming up with a roundtable in a couple of weeks. Yep. Where industry participants will talk about this idea and talk about what it means for the marketplace. But I think the theory is actually runs a little bit counter to the high frequency theory, which is liquidity providers are not incented to provide liquidity, not in the large names, not in the highly liquid names, but in the less traded names, in the large list of stocks that don't see a lot of quoting interest, don't see a lot of trading interest. And in order to provide an incentive for firms to make a deeper, more stable quote in those names, maybe there should be some variation in the tick size. Now, I don't think we know that for sure. That's a theoretical argument.
Right, which is why we're looking for a pilot.
Which is why I think a pilot works here. And I think the key around the pilot has to be, what are the results we're going to be looking for? How are we going to measure success? Right. What will that mean if it is successful? Before that pilot would or get expanded to something else. And if it doesn't achieve success, then we know the answers, and then we should stop.
Shelve it, yeah. Now, when we're looking at pilots, I assume, we're also looking at pilots basically across venues. So you don't want to be locked into a wider spread when someone has a narrower spread. I assume that the markets would all have a consistent tick size, but would that also include internalization and dark pools, or is that some of the discussions on the table?
Well, I think that's some
of the... You can very easily see that all of a sudden, if you're mandated to, let's just say, have a nickel or a dime, and I can trade in a dark pool at the midpoint or, at pennies, then all the flow is just going to go dark.
Yeah, so I think that's a great point. So I think the point here is that it has to be a holistic market solution as a real pilot. Otherwise, you don't get good results. But I also want to make sure that we're not confusing two issues here, right? So there's a tick size issue in which lit markets can quote it, and then there is what I'll call a minimum price variation or price improvement number as well. Okay. And I could see a pilot evolving in such a way, just as you said, that the minimum width or tick size is a nickel, but the minimum price improvement number goes from being 1/10 of a cent or 1/100th of a penny to 2.5 cents.
Okay, so like a midpoint.
So like a midpoint, which would allow for price improvement, allow for trades to take place off exchange, but at a meaningful number so that we can actually get to the results that we're looking for.
Talking about dark pools, we're starting to see a little bit of tick up in the amount of volume that's being internalized or being traded away from the exchanges. For a while it was around 30%. We're seeing kind of tick up to 33, 34% the last month or two. Now it goes back and forth a little bit here, but it seems like it's moving up. Is this an issue for you guys? Clearly I assume you want trades to trade on the exchange, but for me as an investor or an institutional investor, should they care?
Well, I think ultimately they should care. Clearly we believe in the primacy of transparent markets, and that the best prices are discovered when all the trading interest is reflected in the marketplace, and there's that competition between bids and offers to determine what the best price is. That being said, though, I think there is much to be said that's positive about dark trading. So dark trading has worked very well for hiding your interest in the marketplace, for price improvement, and there's a real value to having off-exchange or dark trading existing. So what we're talking about isn't so much against dark trading as it is let's make sure that the system isn't organized in a way that maximizes the value of order interaction and price discovery. Because one of the things, and we've talked about this a little bit in the past, one of the things that we've started to see is when percentages of dark trading in individual names again, as opposed to the collective average. In individual names, when dark trading starts to get to very high percentages, and there are many stocks that have percentages at 50, 60, 70% that trade off exchange, we believe that there is a decay in price discovery. Because trading interest that is being displayed in the lit market is not being rewarded for putting its trading interest out there. That starts to widen bid-offer spreads, and at the end of the day, that will cost investors.
Now, Carol Compton-Ford, I'm not sure if you know her, she's an academic from Australia, just released a study saying something like names that had more than 10 or 15% dark, all of a sudden, you know, the price discovery started actually eroding, which seemed like an awfully low number compared to where we are on an average of 30%, 33% here. So it'll be interesting to see how this plays out. And there was a hearing, Senate banking hearing, I guess, a couple of weeks ago where you testified. Right. What was your, I guess that was your position at the banking hearing?
It is our position there, which is, and again, I want to be really clear about that. This is not about competition around venues, which I think generally is good for investors and actually makes us a better competitor. But I think what the key for us is that if you have venues in the marketplace that are contributing to price discovery, that's better for all investors. And when you have venues that are not contributing to price discovery, you reach a point where the value of that not contributing to price discovery starts to affect the market for all investors. Now, I haven't read the study out of Australia. Clearly the Canadians have moved in a different direction, which gives us sort of a real example to take a look at. There is increasing academic research around this now about where is the inflection point, and it may be different for different markets.
How do you guys look at high-frequency trading? How do you define it? Is it good? Is it bad?
Well, it's an interesting thing, high-frequency trading. So our view on high-frequency trading is perhaps a more nuanced view than many other markets. So we look at the marketplace really as, are you contributing to liquidity to the marketplace? Are you contributing to price discovery? And we think of that as having a higher value in the marketplace, or a good value in the marketplace, one that we want to continue to incent. If in fact you are causing damage to the marketplace, in the long run, that's not helping anyone. So when we try to construct what we're trying to incent in terms of behavior, we're trying to construct behavior patterns and incentive plans that cause firms to add value to the marketplace as opposed to subtract value to the marketplace.
What you mean by add value to the marketplace versus subtract value from the marketplace is, I assume, the provision of liquidity in quotes? Right,
and so to that end, we introduced in late fall last year a program called the QMM, Qualified Market Maker Program. And essentially what it did is paid incentives for firms to set the inside. You got a higher rebate if you drove the inside MBBO, and to make markets across 1,000 securities.
Okay, so not just 10 or 20.
So not just 10 or 20, but in order to earn those higher rebates, again, you had to generate quotes across a larger set of securities. You had to be on the MBBO a certain percentage of the time, and you got an extra rebate for setting the national best bid and offer. Again, trying to incent behavior that we think brings value to investors.
I want to thank you guys for listening. This is Larry Tabb and Eric Noll, the VP of Transaction Services for NASDAQ OMX. Talking to you from the NASDAQ OMX Marketsite about market structure and some of the hotter issues that impact exchanges. Thanks very much.